Hello friends, so today we are going to discuss a very important topic from Forex exposure and risk management chapter, that is fate of forward contract. Okay, now see, what is this topic all about? Once you take the forward contract, how it gets settled is what is the subject matter of discussion. See, the forward contract can be delivered or can be extended or can be cancelled. Now, even in case of delivery also, it can be delivered before the due date or on the due date or late delivery, which means after the due date. Next, extension also, early extension is possible, which means the contract, say for 1st January you enter into forward contract for 2 months period, and when you reach the March 1st, okay, before reaching March 1st, you extend the contract. Possibility is there. Then there is due date extension. On the due date, okay, the customer comes and extends the contract. And late extension, which means after the due date, the customer comes and tries to extend the contract. Next scenario is the cancellation. Okay, how the cancellation happens? It can happen early, which means before the due date also, the customer can come and ask us to cancel the contract on the due date. Okay, which means the customer can come exactly on due date and ask us to cancel the contract. We as a dealer, we need to, okay, find out how to cancel the contract. So next, late cancellation, which means after the due date, the customer may come and ask us to cancel the contract. And there is another possibility, automatic cancellation. Customer may not come for the next 3 days after the due date. Okay, FEDI rules will be applicable, automatic cancellation will be applicable. These are all the possible scenarios. Okay, see, so 4 types of charges will be applicable in case of this forward contract where there is a default, which means if the forward contract is executed as per the plan, then there is no issue. Okay, as per the agreed rate, it will be bought or sold by the dealer. But okay, in case the contract is not executed as per the original plan, then there might be a situation where swap gain loss may be there, or interest on outlay or inlay of funds will be there, and exchange gain loss may be there, or flat charges will be there. 4 possible, okay, charges which may be recovered from the customer, or which may be even in some cases paid to the customer. So these are all the charges which are applicable apart from the agreed upon forward rate. So what will happen now? You will find out gain or loss from the swap transaction. You will find the interest charges to be paid by the banker or to be received by the banker, and there will be exchange gain or loss, and there might be some flat charges. These are all applicable apart from that, okay, agreed upon forward rate. Are you all understanding? Now see, we will take the example which is given in your institute, the examples which are given in your institute module, and using that we will try to explain all the possible scenarios. See, in your module, there are so many illustrations given. See, in your module, there are so many illustrations given. One by one, we will try to understand. Okay, if the delivery happens on exactly on the due date, then there is no default. This is the first case where there is no default. Okay, delivery exactly happens on due date. See here, illustration number 3. On 1st June 2015, the bank enters into a forward contract for 2 months for selling $1 lakh at 65.5. On 31st July 15, the spot rate was, okay, spot bid and spot offer rate given. Calculate the amount to be debited in the customer's account. Very simple transaction. If you see, okay, the 1st June, he has taken 2 months forward. Okay, the bank, the bank enters into contract for forward sell. The bank is selling $, forward sell for 2 months at agreed upon rate of 65.5. On 31st July, exactly on due date, what will happen? You tell me. Okay, this rate will be considered. This will not be considered. Only agreed upon rate 65.5 will be considered, and the contract will be executed. No default in this case. Are you listening? So this is the first scenario, no default, hence no charges will be applicable. The bank will apply the originally agreed upon rate of 65.5 and will debit the account of the customer. Okay, $1 lakh into 65.5, 65 lakhs, 50,000. First case understood. Now, early delivery. See what happens. See, take illustration number 4 to understand the early delivery. On 1st October 2015, Mr. X, an exporter, enters into a forward contract with a BNP bank to sell $1 lakh on 31st December at 65.4. Okay, so what happens? I have, first we will read the question, then I have pictorial representation for it. Okay, through that you can easily understand. However, due to the request of the importer, Mr. X received amount on 28 November 2015. Mr. X requested the bank to take the delivery of the remittance on 30th November, i.e. before the due date. Okay, see here 2 days difference. 28 November he has received amount. Okay, on 30th November, the customer approaches the bank. Okay, here, yes, exporter na. So exporter will sell dollar to the banker, sell dollar to the dealer, and dealer will buy. Upper dealer 1st October, 1st December na, dealer will buy 3-month forward dollar. 3 months forward buy. Dealer will buy from dollar from the customer. 3 months forward. Okay. Now, Mr. X requested the bank to take the delivery of the remittance on 30th November. Yes, before the due date. See, when is the due date? Now 3 months. Now 31st December is the due date. Before, 1 month before. That 3 months contract is there. 1 month before, just after 2 months itself, the customer, okay, comes and what he says, now today I'll sell you dollars. He says, today I'll sell you dollar, which means the dealer will have to purchase, make an early purchase. Earlier, 3 months forward buy, he took forward buy for 3 months, but now he had to purchase 1 month back, 1 month before, that is on 30th November itself, he has to purchase. Now what will happen? The customer is preponing the transaction. So there is a default from the side of the customer, which means he had to do it on at the end of the 3rd month, but 1 month before itself he comes and asks us to make the transaction. Now, the dealer will ask for some compensation. We'll see how it will be computed. Now, see what happens. The interbank rates on 28th November was as follows. See, he comes only on 30th November. It should have been 30th November. Understandable. 1 or 2 days, I don't care. So it is 30th November was as follows. Spot rate is given. 1 month premium is given. If bank agrees to take early delivery, then what will be the net inflow to Mr. X, assuming that the prevailing prime lending rate is 18%. Interest rate is 18% is given. Now, see how to understand the solution. I'll tell you what happens here. If you see this here, early delivery. This is the case of early delivery. Now, you see the bank, I told you the earlier lecture itself. Okay, you can see the Forex other questions also. I would have told about cover deal. Where, okay, the bank enters the contract with the customer. Simultaneously, it go for cover deal with the interbank market. With customer, what it does now, on 1st October, it enters into 3 months forward by October, November, December, 31st, maturing on 31st December. Now, 3 months forward buy at 65.4. Same day on 1st October itself, 3 months forward sell, it will enter with interbank market. Now, what is the selling rate? What is the rate at which the dealer will sell in the interbank market is not given in the question. No issue. I have put it like this. Are you all understanding? Not given, no problem. Now, next on 28th November, 30th November or 28th November, which means 1 month before, the customer comes and asks us to buy the dollar early. Which means, okay, see, customer is asking, we have to fulfill the contract. So what I do is that I say to the customer that you take the agreed upon rate, I will buy from you at 65.4, but apart from that, there will be some charges because of you only. Okay, this happens now. So whatever charges additionally I have to pay to the interbank market, in the interbank market, whatever is the swap gain loss, that you have to compensate apart from the agreed upon rate. So I will buy from you at 65.4, that is fine. But you have to compensate me for the swap gain loss. What happens? You see, on 28th November, I buy from you. Correct? Now, you see, if I buy from you, okay. Now, Originally, what you had done on 1st October, you had sold the, which means from the dealer's perspective, if you see the entire fate of forward contract, I told you, you should, see from the dealer's perspective. Now, you tell me, friends, on 1st October, you have bought dollar at 65.4. Next day on same day itself, you would have sold 3 months, thinking that the maturity will be 31st December. The maturity date will be 31st December, thinking that you sold a 3-month forward contract in the interbank market. Now, what happened? Really speaking, you had to buy on 28th November itself. You had to buy on 28th November itself. Correct? You have to prepone your purchase 1 month before itself. You have to buy. In that case, you will have dollar in hand. What will you do? I told you, if you have dollar in hand, it is too risky. The forex market is like ladder. Which means if lower dealer buys from the customer and the lower dealer sells to the open market, he doesn't keeps the exposure open, which means he buys from the customer at 65.4 on 28th November or 30th November. He need to immediately sell in the interbank market, which is what he is doing. He is doing a spot sell. He is doing a spot sell at 65.22. Now, this transaction, you need to visualize that this transaction is with interbank market or with customer. The transaction is with interbank market or with customer. If it is interbank market, which rate you will take? Very simple. I'll tell you what happens. If this transaction now on 28th November, on 28th November, this is a spot rate 65.22 given, 65.27 given. Now, you are selling in the interbank market. You are selling to the customer interbank market, which is a hierarchy. Which means is a higher dealer, bigger dealer. You go to the bigger bank and you sell. If you go to interbank and sell, there at their bid rate only you can sell, which means you can sell dollar at 65.22. Are you all understanding? You can sell dollar at 65.22. And see here what happens. You can sell at 65.22. Then this happens today. You sold the dollar. Agreed. But apart from that, what happens? Initially, you sold on 1st October, 3 months forward sell. That on the date of maturity, which means on original maturity date, 31st December, this amount, you need to sell. Are you listening? This is open now. It is not closed. I would like to close the contract, which means how to close the contract? 3 months forward sell. You need to, on the same date of maturity, you need to take a counter buy position to close the contract. Are you listening? I have told you many times. So 3 months forward sell I have taken initially, but 2 months already elapsed, 2 months gone, only 1 month left. You are sitting on 28th November, which means 31st December. Now 1 month is pending. So I will take 1 month forward buy to close the original forward sell. Are you all understanding? Which means these two transactions which I highlighted in yellow, it is nothing but swap transaction. Because of you I am doing, because of the customer I am taking the corresponding opposite transaction, which means today I am spot buying from customer. I will have to sell it in the interbank market, and originally I had sold that position I need to cover up. I need to buy. Since 2 months gone, 1 month forward buy I need to take to close this position. Are you all understanding? So these two transactions I call it as swap transaction. The difference between, which means I sell at 65.22, I buy at 65.42, which means this difference, 0.2 is the difference. This 0.2 difference, I call it per dollar. I call it as swap gain or loss. Now, gain or loss, to calculate the gain or loss, if you see, you are buying it because of you. I need to buy at a higher rate. I need to sell at a lower rate. And hence I'm incurring loss. This loss happens because of the customer. I need to recover it from the customer. Are you all understanding the swap transaction? This is how it is computed. Can you see it? Here, see, spot difference. The bank sells at a spot rate 65.22 in the interbank market. Bank buys at a forward rate, which is 65. See here, if you see the forward rate, where it is, you need to buy up a 1 month forward rate. Which rate I will use? See, 1 month premium is given, which means you need to add a 10, 15. okay, ascending premium, you need to add. So 65.22, 65.27, which rate you will consider? Bid rate, offer rate? You need to sell a buyer, you need to buy from the interbank market, your bigger dealer, you will buy at offer rate 65.27 plus 0.15, 65.42. This is the this is the rate at which you will buy the dollar, 65.42, and 65.22 you will sell. So the differential amount is swap gain or loss. What is that? Swap loss. Okay, this loss should be compensated by the customer. I incur loss, na? This loss should be compensated. 20,000, that is $1 lakh into 0.2. Okay, I get a 20,000 swap loss. This should be compensated by the customer. Are you all understanding the swap gain or loss? Next, I'll move on to the interest on outlay of funds. Very simple. How to understand the interest transaction? That also you can see it from here. See, very simple. What happens in the interest transaction? See, now, I have to buy from you because of you. I have to, okay, urgently buy from you on 28/11 itself. How much? By paying 65.4. This is the outflow. I am buying from you by paying 65.4 per dollar. I am buying from you by paying 65.4 and I am selling at what rate? I am selling at interbank market today itself, spot sell. How much I am selling at? 65.22. Are you all understanding? What I am saying is very simple. Bank is buying at 65.4 and bank sells at 65.22 on the same date, which means because of you only, I need to buy at a higher rate and okay, sell in the open market at a lower rate. Agreed? This net outflow of 0.18, okay, this I am losing now. For this is for every dollar, I am losing 0.18 into $1 lakh, which, okay, this is the capital base. This is the capital extra amount. I prepay, which means this actually, if you see the 31st December should have been the maturity date. But because of you, I make these two transactions on 20th November itself. An outflow. Are you all understanding? So I am incurring 0.18 per dollar into $1 lakh. This is the outflow. For 1 month, my capital is locked. Since I paid a higher price, my capital is locked with you. You have to compensate me for the loss. Okay, this is the opportunity cost. I need the interest portion. See, I need to get the compensation as interest. See, that is what is given. On 28th November, bank sells at 65.22. It buys from the customer at 65.4 and okay, the 0.18 is the capital into 1 lakh. I get 1 lakh into 0.18 into, okay, this is 31 days divided by 365 into 18%. 1 month interest they have taken as 31. Since December has 31 days now, 31 divided by 365 into 18%. Okay, this much interest I will lose on the locked capital, 275. Additionally, you should compensate. Are you all understanding? So these two amount you need to compensate. What is that? Okay, swap charges 20,000 and interest totally comes to 20,275. Upon net inflow to Mr. X, if you see the net inflow, see what happens. Agreed upon sale amount will be 65.4 into 1 lakh, which means the customer agreed to sell. Now, he is an exporter. He sold to bank and the bank will give him 65 lakhs 40,000 agreed upon rate. But this loss, he should compensate. So what he will do, the banker will deduct this loss amount and only pay you 65 lakhs 19,725. Are you all understanding the first example? Now, this is about early delivery. This is about early delivery. Now, we can move on quickly here. Late delivery. See, what happens in case of late delivery? See. Now, you have second option, that is late delivery. See, due date delivery, no default I have given. Anyway, late delivery, what happens? You see, okay, listen to me, friends. If you are late, it may be extension, it may be cancellation, or it may be delivery. If you are not coming on due date, okay, old transaction will never be executed. It will always be cancelled. And new contract will be issued. It is as good as, okay, cancelling the old contract and issuing a new contract. Are you understanding? Even though the name is like delivery, they will deliver you at an agreed upon rate, but it will be as good as cancelling the old contract and issuing a new contract, which means you have to compensate. It will be treated on par with cancellation. See, Sorry, what happens? We will see. Late delivery, old contract will be cancelled and new contract will be provided. If more than 3 days from the expiry, the automatic cancellation provisions will apply. See, generally what happened? Late delivery, na? Okay, 31st, you enter into contract which is maturing on 31st of December, and uh, first, second, and third, okay, you did not come even on 3rd of January, which means, okay, the automatic cancellation provisions will apply. If you come on 1st January, then see, then also cancellation will be applicable, but not automatic cancellation. Are you understanding? There is a difference, I'll tell you. See, in case of normal cancellation, what will happen? If there is any exchange gain or loss, cancellation, there will be exchange gain or loss. Another type of, see, there are 4 type of compensation, exchange gain or loss, swap gain or loss, then there will be interest, then there will be flat charges, if any given in the question. Now, exchange gain or loss will always be there in case of cancellation. In case of cancellation, the name itself is cancellation gain or loss. Now see what happens. Normally, if you come within the 3 days period, okay, it will be cancelled and new contract will be issued. But if there is any gain from the cancellation, that will be given to the customer. If there is any loss to the dealer, it will be compensated by the customer. But in case of automatic cancellation, which means even after 3 days you are not coming, FEDI rule will be applicable, automatic cancellation rule will be applicable, which means after 3 days, if you are coming, then the gain will be not shared with you, which means the loss will be compensated by customer to the banker. But if there is any exchange gain, that will not be compensated to the customer. Are you all understanding? So this is what happens in case of cancellation. So to summarize it, late delivery also will be treated on par with cancellation. Old contract will be cancelled, new contract will be issued. Hence, I'm not discussing anything here. Okay, once we discuss cancellation, everything will be clear. Exchange gain or loss, how to compute, that's all. Are you all understanding? Next, we will proceed to cancellation. Okay, once you understand the cancellation, everything will be same. Now, due date cancellation. See, very simple. First case, this is, now we are moving on to cancellation. So delivery case is over. Now we are moving on to cancellation. Exactly on due date, okay, the customer comes and cancels the contract. What will happen in this case? Okay, next we have the illustration, cancellation on due date illustration. See, illustration number 5. Illustration number 5. Take illustration number 5. On 15th January 15, you are a banker, you as a banker booked a forward contract for US dollar 2,50,000 for your import customer deliverable on 15th March 15 at 65.3450. On due date, customer requests you to cancel the contract. On this date, quotation for US dollar in the interbank market is as follows. This is given. Okay, interbank market rate given, spot rate given, and spot April given. This is to be understood as forward rate, even though they have given spot April, but it is to be understood as forward rate because you are standing on, see, on this date they have given, which means on this date, now 15th March, this is the quotation. So this is March, 15th March spot, this is forward April, this is forward May. Okay, assuming that the flat charges for the cancellation is 100 and exchange margin is 10%, then determine the cancellation charges payable by the customer. Very simple. See what happens in this transaction. What they say, originally they booked the contract as 65.3450. Same again and again we will discuss. Okay, this side is the transaction with customer. This is with interbank market. Okay, with customer, if you see, initially on 15th January, what happens? 2 months forward sell. 2 months forward sell, because the import customer, you have agreed to sell the dollar at 65.345. This is the original transaction. Same day, what will you do? You will take a cover transaction, opposite transaction, 2 months forward buy. I don't know what is the cover deal here, what is the rate at which I cover my deal. More or less, approximately, it will be same, because same day you go and cover. Okay, now this rate is not given in the question, no issue. We'll take it. Some question they may give the rate, some question they may not give the rate, no issues. Okay, we'll just put it simply like this. Next, 15th March, on 15th March, which is the due date, correct? On due date, what happens? Customer asks and okay, we cancel the contract. Customer asks to cancel the contract. What you should do? We need to cancel the contract. Tell me, children. Now, originally it was a sale contract. Up a 2 month forward sale. You need to cancel today. I told you how forex market, how you cancel the contract, take the opposite corresponding position, which means 2 months forward sell na. Now you need to buy and close the contract, correct? You need to counter buy and close the contract. You tell me, you need to take 2 months forward buy, you need to spot buy because 2 months already elapsed. You are sitting on 15th March. After 2 months, when you want to close the original contract which was taken 2 months back, how to cancel it? Okay, spot buy. I will take a spot buy position and cancel it. Here only important discussion. When you spot buy, you tell me, children, this you are cancelling the transaction is with customer, is with interbank, is with customer, which means so you have to spot buy, which means you have to buy na, customer will sell at what rate? That is important. Okay, customer will sell at 65.2975 or 65.29. Customer will sell means he will sell at bid rate, offer rate. He will sell at bid rate, offer rate, bid rate 65.29. He will sell at bid rate. Are you all understanding? You are buying from customer, you are buying from interbank market. If you buy from interbank market, you have to pay at a higher rate, 65.2. Higher rate 95 or something which is given, you have to take that. But here you are transacting with customer, hence you will buy from the customer. It is as good as customer will be selling at what rate? Bid rate 65.29 should be considered. Now because of you, what happens? I bought from you, fine, okay, I close the contract, but because of you already I have taken a position, buy position, that also I need to cover deal. I have taken cover deal originally 2 months forward buy. That also I need to pay, okay, close na. I need to transact in the interbank market. One more transaction I need to make. Okay, whereby I need to pay the exchange margin, which means exchange margin will be paid. This exchange margin will be compensated from you because of you only, because of your cancellation only. I have to incur some more charges. For that, I will charge you the exchange margin, and I will only pay you the net amount, which means if I am spot buying 65.29 for every $1 of you, I will only give 65.29. I will only give 65.2247. 65.2247 exchange margin I will recover. Hence here I am reducing. Okay, I'll get 65.2247 rounded off to 0.0025. Every transaction mostly will be rounded off to point. Some question in few questions they might mention it directly. Even if they don't mention, you have to round it off to 0.0025. 0.0025. Okay, that is there, and 65.2247 will be rounded off to 65.2250. Effectively, the 65.29 only became 65.22 after deducting the exchange margin. Now, important discussion. These two transactions, I call it as cancellation charges. The difference between 65.35 and the net amount after considering the exchange margin, 65.2250. This difference, I call it as cancellation difference, which may exchange gain or loss or cancellation charges. Okay, I need to charge from you. Now, here one important observation. Sir, I made a forward sell. I sold at 65.345. I am buying at 65.225. I am selling at a higher rate, buying at a lower rate. Okay, why I have no loss and I have gain only. I don't have any losses. So, the banker should compensate the customer. Customer should compensate the banker. Here only you need to carefully observe what happens here. This is not the real, see, how to understand this transaction, I'll tell you. In case of cancellation, originally, you agreed to buy, you agreed to sell the dollar. You agreed to sell the dollar at higher rate. Today, what is the rate? 65.2250. Today, if you see the exchange rate, it is only 65.2250. Which means, today it is a lower rate. But I have already agreed with you to sell my dollar, dealer's dollar, at a higher rate of 65.35, but because of you, the obligation you had, but you get out of the contract, you run out of the contract. Because of you running out of the contract, I have to, sell at only 65.225. Are you listening? My dollar, I can only buy or sell at 65.2250, lower rate. Okay, I could have sold at a higher rate. If you fulfilled your obligation, you did not. Hence, this loss I'm incurring now, this you have to compensate. Are you all understanding? This is why, okay, this has to be compensated by the customer. This has to be compensated by the customer. If you see here, solution, can you see here? See. Now, the spot buying rate 65.29 and I reduce the exchange margin. I get 65.2247 rounded off to 65.2250. So dollar sold to customer at 65.3550, dollar bought from customer 65.2250. The difference is 0.12 and okay, this will be compensated per dollar. This is per dollar for $250,000 if you apply. Okay, the cancellation charges will come to 30,000 and flat charges 100. Totally you need to amount payable by the customer. This is why you need to compensate 30,100 rupees. Are you all understanding this clearly? Shall I proceed? Next, early cancellation. Here, early cancellation. See, we studied now cancellation on the due date. Due date cancellation we studied. Now early cancellation. Shall we see early cancellation? See here. Take illustration number 6. Through this, we will understand early cancellation. You as a banker has entered into a 3 months forward contract with your customer to purchase Australian dollar 1 lakh at the rate of 47.25. However, after 2 months, your customer comes to you and requests cancellation of the contract. On this date, the quotation for Australian dollar is given as spot 47.3 and 47.35. 1 month forward rate is given. Determine the cancellation charges payable by the customer. Now, this is due before due data, on the due data, before due date, which means before due date itself I come and I say I need to cancel, which means originally I took 3 months forward. Then, okay, before due date itself, which means after 2 months itself, I come and cancel, or the customer comes and asks for cancellation. Are you all listening? Now, what I need to do, okay, I need to cancel, correct? So, I will show you what is to be done here. Illustration number, okay, this is due date cancellation. This is over. Early cancellation. Next, illustration number 6. This is the illustration. See, early cancellation. What happens on 1st January, 3 months forward date is not given in the question. I have assumed for simplicity. On 1st January, assume 3 months forward buy is there, 47.25. The dealer will buy from the agreed to buy from the customer at 47.25. Thereafter, okay, what happens after 2 months? After 2 months, which means on 1st March itself, he comes and asks us to cancel the contract. You need to tell me, how can a 3 months forward buy can be cancelled after 2 months? See, say maturity should match, which means you are now staying after 2 months. How many months will be there pending? 1 more month. Up 1 month forward, sell you need to do. The buy was there. Initially you bought that. You need to cancel out. Now corresponding opposite position. What you need to do? Counter sell. Okay, 1 month forward sell position you will take. What is the rate at which you will sell? 47.52. 47.52. Again, you are selling to the customer. You are selling in the interbank market. You are selling to the customer. If you are selling to the customer, what will customer do? Customer will have to buy. Customer will have to buy, okay, lower rate, higher rate, forward rate, spot rate, forward, 1 month forward, which means 1 month forward offer rate you will consider 47.52. 47.52. This is what given in the question solution. See, 47.52 is on the cancellation. It is sold to him, which means you sell it, okay, and customer will buy at a higher rate of 47.52 and original forward contract, okay, 47.25. The differential amount is 0.27 will be cancellation charges payable by the customer. Cancellation charges payable by the customer. Here also, if you think, if you carefully see what happens here also, okay, I bought at 47.25. I bought at 47.25. I am selling at 47.52. Sir, lower rate only I bought and now I am selling at a higher rate. Okay, dealer will have gain. You should not think always. Okay, you should never think like that. You see, dealer had agreed to buy this at a lower rate, but today it has increased. So the dealer is losing the benefit of, okay, buying the contract at a lower, buying the dollar at a lower contracted rate. Hence, the customer needs to compensate the dealer. Are you all understanding this 0.27? I call it as cancellation charges. Now, late cancellation. Again, I told you, late cancellation, there are two possibilities. Late cancellation, late cancellation, there are two possibility. One is after say 1 or 2 days you come, before the 3 days, after 2 days assume, and the after 3 days, two possibilities are there now. If the customer doesn't come up between the 3 days, then automatic cancellation provision will apply, and if he comes within the 2 days, the normal cancellation provision will be applicable. I told you earlier, transaction will be cancelled, and it is as good as the within 2 days if he comes and cancel, there will be some swap gain or loss also. If question mentions you swap transaction, it is given in the question, now you will consider it. If not given in the question, then ignore it. Are you understanding? Normally there will be swap. What happens, I will tell you. See what happens. See, I'll take a pen and explain here. See, customer, there are two possibilities. This is, assume this is maturing on 31st of March. Now the customer may come on 1st April, or he may come on 4th April, or he may not come at all. Assume. So there are two possibilities, correct? Before the 3 days after the due date, or even after 3 days, after 3 days of due date, which means, see, in this case what will happen? Normal cancellation provision will apply. Here automatic cancellation provisions will apply. I will discuss the automatic cancellation, last illustration there, comprehensive illustration, which includes all the charges, that we will discuss anyway. Automatic cancellation, normal cancellation, what will happen? Cancellation, old contract will be cancelled, because there is no extension, this is only cancellation, so old contract is to be cancelled, fine. But he is coming on 31st March, on 1st April, which means on the due date, if he doesn't come on due date, what happens at the end of the day? What will happen? The banker, the dealer will take an open transaction, because he doesn't know when the customer will come. He takes a swap transaction in the interbank market. Are you all understanding? To hedge his position, he takes a swap transaction, whether or not the customer comes, because he doesn't know when he comes. So when the customer comes, that's the contract will be closed. Are you all understanding? When the customer comes, he will cancel the original contract, but till the time he cancels the original contract, he will take a swap transaction. This we will explain. In case of automatic cancellation, you will understand. Shall I proceed? This is about late cancellation. Two possibility: normal cancellation, automatic cancellation. Anyway, both are cancellation, hence I'm not discussing. Same exchange gain or loss will be applicable. Very simple. At the end of the discussion, I'll summarize where interest will be there, where swap gain loss will be there, where flat charges will be applicable, and where you will have this exchange gain or loss. To put it simply, exchange gain or loss are cancellation charges. Wherever customer cancels, cancellation will be applicable on late delivery, because within the due date, if customer doesn't come, it is as good as cancellation of the old contract. I told you, even if it takes delivery, it will be as good as cancelling the previous contract and issuing a new contract. So late delivery case and all the extension cases and all the cancellation cases, everywhere cancellation gain or loss will be there. Cancellation gain or loss will be anyway there. Now, this is about cancellation. Come to the extension case. Extension is also, see, very simple. Extension, how to understand extension? Extension will be treated as cancellation plus issue of new contract. Cancellation and issue of new contract. Now, see here only, we have the illustration number 7. Illustration number 7. So, illustration number 7. Suppose you are a banker and one of your export customers has booked a US dollar 1 lakh forward sale contract for 2 months with you at the rate of 62.52, and simultaneously you covered yourself in the interbank market at 62.59. In this question, if you see, the cover rate is also given, the transaction rate with customer as well as the cover rate in interbank market, both have been given. However, on due date after 2 months, your customer comes to you and requests for cancellation of the contract and also requests for extension of the contract by 1 month. On this date, quotation for US dollar in the market was as follows: spot rate given, 1 month forward rate is given. Determine the extension charges payable by the customer, assuming exchange margin of 0.1% on buying as well as selling. See, what they say is that initially an export customer came to you and okay, he will sell the dollar, which means as a dealer, this is from the dealer's perspective. If you see, you will take a 2 months forward buy. The customer would have sold to you, okay, will be selling to you, so you will take 2 month forward buy at 62.52, and the same date, on the same date, 1st January, assume, is going for a cover at 62.59 rupees. This happened today. Now, what they say, this is the example, what is for extension on due date, extension on due date. Now, after 2 months, say on 1st March, okay, 1st March, the customer says that I want to extend the contract. I want to extend the contract, okay, for one more month. I want to extend the contract for one more month. Are you all understanding? So again, extension, I told you, it is nothing but first you will cancel the old contract. First you will cancel the old contract. New contract will be executed as if it was entered into on the date of due date, whenever the customer is coming and asking you for extension. Here the customer is coming and asking you for extension on the due date, correct? So from there, okay, 1 month, a new 1 month contract, it is as good as issuing a new contract. So first you need to cancel out. Agreed? So cancel, how to cancel on 1st March? Okay, you need to counter sell. You have, okay, you have bought the dollar, so 2 month forward buy you had made to close this. But when are you closing? On the date of maturity. To close this, you will have to spot sell. You will have to spot sell. Again, here only you need to carefully observe. Spot sell, I'm selling it to customer. I'm selling to close the contract of the customer. So which means I will sell at bid rate, offer rate, offer rate. I will sell at offer rate, which is 62.72 plus exchange margin. Okay, because of customer only, I am incurring this. Okay, hence I am doing this transaction. Hence I will, okay, for every buy as well as for sell, I will incur the exchange margin. I will recover the exchange margin from the customer. How much is that? 0.10%, 0.10%, that is 0.06272. It comes to 62.7827. I should round it off to 0.0025, which comes to 62.7825. Are you all understanding? So I'm selling at 62.7825. I'm buying at 62.52. Again, you tell me, sir, I bought at a lower rate of 62.52. Here I'm selling at a higher rate. Okay, will I gain or will I have loss? Really speaking, the dealer will have loss and the customer should compensate, because see, I have already agreed to buy at a lower rate, whereas the price is higher today, but because of you cancelling, I lose that benefit. I lose the benefit of buying the dollar at a cheaper rate from you. Hence, what happens? You have to compensate me this 0.02625, the difference between the 62.52 agreed upon rate and this rate. Okay, I call it as cancellation charges, $0.2625. Okay, 25 per dollar will be the cancellation charges. So this is about cancellation. Again, now new contract has to be booked for 1 month because he has asked for extension. So 1 month on 1st March, 1 month forward buy. Again, you will take new buy. At what rate? 62.64. 1 month forward rate, 62.64. Bid rate. Why? Because I am buying from the customer. I am not buying from the interbank. I am buying from the customer. Now, customer needs to sell his dollar. When customer sells his dollar, okay, I will buy at a lower rate of 62.64. Are you all having the clarity? Okay, the solution also given here. You see what is the difference? Okay, the difference is 0.2625 per dollar. $1 lakh, 26,250 is the exchange loss which has to be compensated by the customer, payable by the customer, and rebooking the contract. 62.64 will be there, plus exchange margin, minus exchange margin, minus exchange margin, because you are buying from the customer. When you buy from the customer, you again recover the exchange margin. Okay, even further the buying rate will be reduced to 62.57, 57736, which is rounded off to 5775. Are you all understanding? Again, buying also exchange margin will be applicable. Here for selling also exchange margin. Here for selling also exchange margin will be applicable. Buying as well as selling. Right. So this is all about due date extension. Due date extension, where you cancel the contract on the due date. okay, rate prevailing on the due date, and you provide the new contract at the rate prevailing on due date. Are you all understanding? So 1 month forward prevailing on the due date will consider. Next, okay, extension before the due date. Next situation in a extension before due date. Extension before due date. Early extension, which I can also call it as early extension, right? See illustration number 8. Suppose you as a banker entered into a forward purchase contract for US dollar 50,000 on 5th March, which an export customer for 3 months at the rate of 59.6. On the same day, you also covered yourself in the market at 60.6025. However, on 5th May, remember what he does now, 5th March, he takes 3 months contract, April, May, June. Really speaking, the maturity date is 5th of June, but the customer comes on 5th May early, 1 month early, and asks you to extend the contract to 5th July instead of 5th June. Original 5th June, 5th July he is asking to extend. On this date, 5th May, quotation for US dollar in the market is as follows. Spot rate given. See here also mistakenly spot rate, the forward rate. Okay, this and this are nothing but forward rate. Okay, really speaking, forward rate. Next. Now, spot rate given, forward rate, bid and offer rate given, forward rate for June given, forward rate for July given. Assume margin of 0.10% on buying as well as selling. Determine the extension charges or the cancellation charges payable by the customer and the new rate quoted to the customer. See, this extension charges payable by the customer is a cancellation. Okay, and I told you now this will be cancelled and new contract will be issued at new rate. Are you listening? Rates to be rounded off 4 decimal to 0.0025. This we already considered, even though it will not be given in question in some cases. We will consider, obviously. Say, now see the solution. Now what happens? You tell me. Initially, see here. We have the representation. Early extension, illustration number 8 of the study mat. See. 5-3 on 5th March, 3 months forward buy I will take at 59.6 and 3 months forward sell also given. The interbank market exposure amount is also given at 60.6025. This happens on 5th March. Okay, maturity in what is the maturity? 3 months, which means April, May and June. June is the maturity period. Say on 5th May, 1 month before, he comes and asks you to cancel, extend the contract. Effectively, first we need to cancel, then reissue the contract. Cancel the contract at what rate? See, earlier I took buy 3 months forward buy, 2 months gone. Now balance left 1 month. To close this, what will you do? 1 month forward sell. Earlier you took buy position. Now to close it, you say take sell position, 1 month forward sell at 59.2425. How we got 59.2425? This is a transaction with customer. Now what rate I will use to sell dollar? See, you are selling dollar. Now customer will buy dollar. Customer will buy dollar at bankers. Buying rate or selling rate? Selling rate 2425. Okay, 59.2425, which is forward rate for 5th June. 1 month June, you are sitting on 5th May, and 1 month future sell you are making. Okay, this is offer rate to be considered. Are you all having the clarity? Now see, this is the offer rate 59.2425. Then we have exchange margin for buying as well as selling. So here you sell now, so you apply this exchange margin, you will get 59.3017 rounded off to 59.30. Okay, this the difference between this number, original contracted amount 59.6 and this revised number 59.3. 0.3 per dollar will be your exchange gain or loss. Here only again exchange gain or loss. See, now the customer buys at lower rate or higher rate of 59.6 higher rate and sells at a lower rate. See, gain or loss. See, really speaking, the contracted rate is higher, but today the rate is cheaper. Okay, by exiting this contract, customer is exiting this contract. Customer is cancelling this contract. Because of customer's cancellation, what happened? You are avoiding your obligation to buy at a higher rate, or you are listening, even though the rate is cheaper, which means you are benefiting as a dealer. You are benefiting because of whom? The customer. So what will you do? You will pay back the benefit to him. So this is payable to customer. This is payable to customer. This benefit is payable to customer. This is the important observation. Banker had obligation to buy at 59.6 higher rate, which is avoided because of cancellation. Hence, banker will compensate the customer. Hence, banker will compensate. Okay, the amount, whatever is the amount, okay, will be considered $1 lakh. What is the amount? Exposure in a 50,000. Okay, so 50,000. What is that? Into 0.2975. Okay, 50,000 is payable to the customer. 50,000 for dollar, 14,875 rupees for the $50,000 is payable to the customer, which means this is benefit derived from the customer. So I will pay back the customer. This is there. And rate of the booking of the new contract, I told you. Anyway, the forward buying rate 59.63, exchange margin will be reduced because, okay, anyway, you will be buying from the customer now. So exchange margin will be reduced. Even at a lower rate, you will buy. This is all about this. And one more important observation in this. Okay, if you see here, now, this is a extension case, na? So, which means extending before due data, after due data, before due date. Before, see, this extension happens before due data, after due data, early extension, which means before due date. Are you all understanding? Now, the next situation, we move on to the late extension, which means I come after the due date and say to the banker that extend my contract, extend my forward contract. Extension always means there will be cancellation plus issue of new contract. That is true. But this late extension, okay, two scenarios possible. One, the customer comes within the 3 days of the due date, okay, and after 3 days of 3 days from the due date. For example, December 31st is the contracted date. And one customer comes on 2nd Jan and another customer comes on 4th Jan. Are you all understanding? Two different provisions will be applicable. For the person who is coming on 2nd January, normal cancellation will be applicable, which means the benefit derived from the customer. Now you give the, compensate the customer, and the loss arises from the customer means you will, okay, recover the loss from the customer, which will be payable by the customer. This is what happens normally. But when he comes after 3 days, automatic cancellation provisions will be applicable. Automatic cancellation provision will be applicable. Very simple. What happens? What is this automatic cancellation? I'll tell you. See, till now what happened? If the dealer was getting some benefit, that was compensated to the customer. And if the dealer had some losses, the customer will compensate the dealer. Are you all understanding? Now, in the case of automatic cancellation, what will happen? Dealer will enjoy the benefit. Dealer will enjoy the benefit. He will not pay back the benefit to the customer. But if any losses arising from this transaction from the customer, that should be compensated by the customer. Okay, I will receive the compensation from the customer, but I will not pay the compensation to the customer if at all it is payable. Even if it is payable, are you understanding? This is what automatic cancellation case. That to enjoy the benefit, okay, positive aspect of the currency fluctuation, you need to come before the 3 days period. If you come after the 3 days period, then automatic cancellation provisions will apply. This is the last set of discussion. Okay, very important area, last illustration, which will cover all the aspects of the fate of forward contract. Shall we discuss this? Okay, within 10 or 15 minutes, we'll complete the question. See, now take question number, illustration number, yes, automatic cancellation, illustration number 9. An importer booked a forward contract with his bank on 10th April for USD 2 lakhs due on 10th June at 64.4. The bank covered its position in the market at 64.28. Okay, the importer, okay, so importer will sell dollar tomorrow. So importer, you will have to buy, as a dealer, you will have to buy this person 10th April for 2 lakh rupees, 10th June, April, May, June, which means 2 months forward buy. The dealer has made a forward buy, 2 months forward sell, 2 months forward. Importer customer, the customer will buy dollar, dealer will have to sell dollar for 2 months USD 2 lakhs. Okay, the dealer has sold at 64.4. Simultaneously, the dealer covered 2 months forward buy he had made, okay, at 64.28. Are you all understanding? Now, Let's see what happens. Exchange rate for the dollar in the interbank market exchange rate given for 10th June, 13th June. What is the importance here? See, 10th June is the normal maturity period, 2 months period, April, May, June. So 2 months maturity period, contract matures on 10th June. But if the customer doesn't come by 13th June, automatic cancellation provision will be applicable. That's why the rate prevailing on 13th June was also simultaneously given. Exchange margin of 0.7%, outlay of funds at 12%. The importer requested on 14th June for extension of contract with the due date on 10th August, which means importer came on which date? 14th. Importer came on 14th after a period of 3 days. After a period of 3 days, automatic cancellation provision should be applicable. The importer requested on 14th June for extension of contract with the due date of 10th August. Okay, 14th June he came. Anyway, August, okay, assume August, he want to take August forward, he want to enter into. Now, next, rates to be rounded of 4 decimal. Okay, in multiple of 0.0025, and on 10th June, bank swaps by selling spot and buying 1 month forward. I told you, see what happens on the due date. I wait for the customer. If customer don't come now, what I do is that I will take 1 month or nearest forward. Okay, nearest forward, because I don't know when he will come. Whenever he comes, okay, I need to execute the transaction. So what I will do, I will swap this current transaction in the interbank market, taking an open position. I call it as open position. Okay, say 1 month or nearest, whatever is the available. Say we will take, for simplicity, we will take 1 month forward. Are you all understanding this? The bank does. And now calculate, okay, cancellation rate, amount payable on 2 lakh, swap loss, interest on outlay of funds, net new contract rate, okay, and total cost. All these 6 things are being asked. Shall we start solving the question? See, very simple. Same drill. Again, you put it like this. On 10th April, 2 months forward sell at 64.4. This is for agreed upon rate. Originally agreed upon rate with the customer. Now, I go simultaneously, this is an import customer, I need to sell him 64.4 whenever he tries to buy. After 2 months, he requests. So what I do, I go in the interbank market and take the opposite position on the same day, hedging. Correct? 2 months forward buy, I will consider it 64.28. So I sold at 64.4. I buy at 64.28. This happened today. Okay. On 10th June, I wait for the customer. But customer, okay, I don't see the customer at all. What I do, okay, I'll take an open transaction. I told you, nearest forward, I will keep buy, which means this will be maturing, which means 2 months forward buy. I took, today, 10th April. Now, on 10th June, it will mature. So what I can do, okay, I have to compulsorily buy. If I buy from the market, what I will do, I will just sell back in the market because I don't have any use. This customer, I want to sell to this customer, but this customer didn't turn up. So what I do, I sell in the market and swap the transaction, which means this buy transaction, I will make a spot sell. And I keep open a June forward, okay, nearest to 1 month forward, so that whenever customer comes, I will give it to the customer. Are you all understanding what is happening? So 2 months forward buy at 64.28 is getting cancelled by spot sell at 63.8. Again, here is important. Now, this is the transaction. This is with customer, and this is with interbank market. Now, interbank market transaction means, tell me children, bid rate, offer rate, spot sell. You need to sell to the interbank market, which is higher bank. Okay, when you sell to a higher bank, you will sell at bid rate, offer rate, bid rate, which means you will sell at a lower rate for that banker. They will purchase at lower rate, you need to sell at a lower rate. Okay, on 10th June, what is the spot June? Okay, yes, on 10th June, you tell me children, if you want to spot sell, you will sell at what rate? See, spot June is a spot 1 USD on 10th June, 63.8. This is what you will take for selling. This 63.8 is the selling rate. Now, apart from that, I will take 1 month forward buy because I don't know when will be the customer coming. So I will take okay, 10th June itself, on the same date itself, 1 month forward, June month forward, I will buy. June month forward, I will buy. Now, June forward, this spot wrongly given, it should be forward because quoting on 10th, na. So, you tell me, June forward, na, I will take buying rate, selling rate, I will buy, na, up buy at a higher rate, which is 95, 63.95, which is 63.95. Are you all understanding? So these two transactions, I call it as swap transaction. I swap with the existing 10th April that is expiring now. So I will swap it with a new June 1 month forward buy, which is 63.95. This differential amount is nothing but swap gain loss. I will recover from the customer. Whenever he comes, I will recover from the customer this amount. So because of him only, I am making this transaction. Otherwise, I need not make this transaction. So I will recover from the customer. Point number 1. Are you all understanding the swap gain loss? So this is how to compute swap gain loss, 0.15 per dollar. Okay, so see here. This I will discuss in a different order. No issue. Here swap loss is there. On 10th June, bank does a swap sale of dollar at a market buying rate of 63.8 and forward purchase for June at market selling rate of 63.95. The differential amount is swap gain loss 0.15. For $2 lakh it is 30,000. Are you all understanding the swap gain loss is the first issue. Why swap is to be done? I don't know when the customer will come. On 10th June due date he is not coming. So I'll take a open transaction. Okay, for that swap gain loss will be there. Next. Okay, next issue in a cancellation. See. Whenever the customer comes, on 13th 6th the customer comes. What happened after, 3 days, what happened? The customer comes and really says that cancel my contract. Okay, see, now the point is here the customer comes only on 14th June. Here the customer only comes on 14th June. But I will not wait till 14th June end. 3 days over by 13th, 11, 12, 13, 13th day end. What I will do? Okay, I will compulsorily close the contract, compulsorily cancel the contract. Are you all understanding? So what I will do? I will make a spot buy to close the contract. See, earlier 2 month forward sell was there. To close the sell, I will take the opposite buy position on which date? 13th June. Why? Because I expected in the next 3 days you will come, but if you don't come, okay, I will compulsorily close on 13th June. Spot buy. Now tell me, this is the transaction with customer, interbank or customer. So which means spot buy, bid rate, offer rate, which rate I will consider? Okay, if you see the cancellation rate, which rate I should consider from the question given? See here, which date you cancel first of all? 13th June. On 13th June, you tell me you are cancelling using spot rate of a spot or forward rate or spot rate because you will have to close it. Now see, this is importer. You would have sold the dollar initially. You have to buy. If you want to buy, you tell me on 13th June, 63.68 you will consider, 63.72 you will consider. This is with customer. If you want to buy from the customer, okay, you will buy at a lower rate, a higher rate. He will sell at a lower rate, 63.68. Are you all having the clarity? So 63.68 I will consider, and exchange margin will be reduced from this 63.68. Even lower amount only I will give. Okay, 63.6136 only I will give, and that also will be rounded off to 0.0025, 63.6175. This amount and this amount, 64.4, the originally contracted rate and the closing rate. Okay, I call it as cancellation rate. This 63.6175 is also called as cancellation rate. This is nothing but cancellation rate, the rate at which I cancel your original contract. So the differential amount 64.4 and 63.6175. The difference is the exchange loss to be compensated by the exchange loss to be paid by the customer. Are you all having the clarity? Okay, this is for every $1, which means totally $2 lakh. What is the cost here? They have mentioned. See here. Now, cancellation rate 63.6163 rounded off to 63.6175. Amount payable on 2 lakhs. Okay, bank sells at 64.4, buys at 63.6175 from the customer. Okay, the differential amount, if you see 1,56,500, this is the total, okay, gain or loss to be compensated by the customer for $2 lakh exposure. Are you all understanding? Now, cancellation over, swap gain loss over. there will be interest also in this case. Sir, why interest arises? Very simple. See what happens. I will show you here. Interest calculation, little bit tricky here. Tricky in the sense, very easily understandable only. See what happens if you did not cancel the contract. If you come on due date, assume if you came on due date, okay, which is 10th June, you did not come on due date, okay. Now, if you come on due date, what will happen? I need not have any other transaction. Are you all understanding? So because of you, what happened on 10th June, okay, I purchase, this is the, original cover deal. I will show you here, see the 64.28, originally I forward buy, I had to spot sell, which means originally 2 months forward buy will be there now. The contract will be entered into on 10th April, but this contract will be executed. I need to buy on which date for transaction to be taking place on future date, 10th June. About the 64.28, I need to pay to the interbank market to get the dollar. How much? 64.28. Are you all understanding? This will be my outflow on 10th June. 10th June, I required to pay 64.28, and while selling, I only get 63.8, which means I pay more than what I get. So, because of you only, I bought at 64.28 and sold at 63.8. Hence, okay, my capital is locked up. That differential amount, if you see the 64.28, 63.8 is the inflow. The differential net outflow is 0.48. This much per dollar, my money is getting blocked in the market because of you. For that, I will charge interest. So 0.48 into $2 lakh. Okay, and this is the interest for when a customer comes on 14th June. So after cancellation, interest will not be calculated. Once the contract itself is getting cancelled, now what is the use of taking interest? Are you all understanding? So on whether you come on 14th June or 15th June, that is irrelevant. The contract will be cancelled on 13th June. So 13th June till 13th June, 3 days is there now, 10th June to 13th June. So 3 days interest I will charge from you. How much? 0.48 into $2 lakh into 3 by 365, okay, at 12% to 12% I will get as the interest. Are you all understanding? This is how they have computed the interest on outlay. See, interest on outlay of funds on 10th June, the bank receives a delivery under, okay, cover at 64.28, it has to pay. This is the outflow and this is the inflow. The differential amount is 0.48 per dollar. For $2 lakh, it is 96,000. And for 3 days, which is 3 by 365 into 12%, I get interest as 96 rupees. I get as interest as 96 rupees. Okay, new contract rate, that is not an issue. New contract rate, I'll come back to the new contract rate later. See the total cost. So we have interest cost, swap gain loss, swap loss, and cancellation charges. Total cost comes to total cost, total compensation needs to be paid by the customer to the banker, which is 1,86,596. Are you all having the clarity? Okay, now the old contract gets cancelled. This is the compensation amount and all that. What is the new contract rate? See the question properly. What he wants after 4 days. So 14th June he comes and asks us to extend the contract for 10th August. For 10th August quotation I require. He is importer. He will buy the dollar from you, which means you need to sell the dollar to him. You will sell the dollar August 13th. Assume 13th and 14th are same. Ideally 14th quotation should be taken because here they have not given 14th day. So I will take the nearest day, 13th June quotation. So August I need to sell at what rate? 64.25 or 64.18 or 64.28 offer rate you will sell. Okay, that is what is the given new contract rate, 64.25, and again exchange margin will be added this time. Why? Because you are selling up a higher rate only you will sell, which is 0.06 or 64.3143, again rounded off to 64.3150, 0.0025. Okay, you will round off the nearest 0.0025, which is 64.3150. Are you all having the clarity? This is everything regarding the fate of forward contract. Now, I will show the summary to remember the transaction. I will discuss here briefly. Okay, see, when the swap gain loss will arise, first, when will this kind of charge arise? Swap gain loss will be there. Very simple. In case of early delivery, there will be swap gain loss. Why? There is a timing difference. Okay, you take early delivery 1 month before itself. You take the delivery. Now you go to the interbank market and do the adjustment. So early delivery, there will be swap gain loss. Late cancellation, there will be swap gain loss. Why? Because I may be late by 1 day, 2 days, or 3 days, or even 10 days. But I told you now, the bank generally what will do, on the due date, they will see whether the customer is coming. If not, they will take an open transaction, which means late cancellation. Okay, the open transaction which you take, that has to be swapped in the interbank. So that will be applicable. Late cancellation within 3 days, it will be there. Automatic cancellation, which means irrespective of when the customer is coming, there will be surely swap gain loss. Are you all understanding? So there will be surely swap gain loss. Okay, here automatic cancellation, swap gain loss will be there, late extension will be there. These 4 cases, okay, and late delivery also. Even if you take delivery, what happened? Okay, see, even if you take delivery after 4 days, cancellation will happen. Cancellation will happen and new contract will be issued. Cancel now, old contract will be get cancelled, but on that date they don't know when you will come. So what they will do? They will take a 1 month open transaction, swap transaction, but it will not be, it may not be given in the question every time. Which means only when the details regarding the swap transaction given in the question, you should consider. So what is the details regarding the swap transaction? I'll tell you. See, in this question number 9, if you notice, they have clearly mentioned what the company is going to do. See, now, what they say, on 10th June, bank swaps by selling spot and buying 1 month forward. They have given clearly. If they have clearly they have given and the rates quotation also given, now you will consider the swap. Otherwise, you ignore, only do the cancellation. In the illustration 7 or 8 we discussed. Now, there only we did the cancellation. Okay, we do not show the swap, but there will be swap also. Are you all understanding? Late extension, all this will have swap as well. So, these are all the possible scenarios where swap gain loss will arise. Next, when exchange gain loss will arise, this is a very simple and straightforward issue. Exchange gain loss will arise only in case of cancellation. Only in case of cancellation. Now, cancellation, it need not be only cancellation. Extension also effectively you are cancelling. Are you listening? So, all the extension cases as well as cancellation cases as well as late delivery cases. Very simple. Late delivery also, even though you are delivering the contract, but the problem is in case of late delivery, effectively actually the cancellation will happen, then the delivery will happen at the new rate. Are you all understanding? So this is there in all the cases of cancellation, including late delivery and extension, as old contract will get cancelled. When interest will be there? When interest will be there? Very simple. Early delivery, late cancellation, late extension, and automatic cancellation. To put it simply, interest will not be there where the transaction happens on the due date. For example, early delivery, you take delivery early, right? So early date to the due date, there will be interest. So which means there will be one buying as well as selling. So differential amount will be the interest charge, capital locked. Okay, late delivery will be there, late extension, late cancellation, late extension, automatic extension. In all these cases, if you notice the late delivery, late cancellation, late extension, automatic cancellation, in these 4 cases, swap transaction will happen. Wherever swap transaction happens, most probably interest will be there. When flat charges will be there, next last point, only if questions ask us specifically, okay, flat charges, they might give 100 rupees. Okay, 500 rupees. Like this flat charges per transaction will be given in the question. Okay, which only should be considered. Okay, which should be considered only if it is specifically given in the question. Are you all understanding? With this, we are through with the discussion completely. Okay, regarding the fate of forward contract. Revise 1 or 2 times. Okay, you will be very comfortable. And I will share this notes as a PDF in our website also. It will be available. I'll try to put it in the description, or we'll have this in website. Okay. Now, thank you. And we will cover a few more topics regarding the real options and other areas in the next segment. Okay. Thank you.